Welcome back to the Pro Ticker Podcast, your Friday morning edition covering major financial magazine headlines, everyone. It's Friday, August 15th, 2025, and here on the Deep Dive, we're cutting through the noise. We're trying to extract the most important nuggets of knowledge from today's financial narratives. Our mission, as always, is to help you understand what truly matters.
Exactly. And this morning, we're looking at a fascinating array of stories. When you connect them, they really paint a vivid picture of the global financial landscape, maybe at a critical juncture. We'll be pulling insights from, Bloomberg, Barron's, other key sources, revealing the patterns, the implications behind these headlines, really trying to move beyond just the facts to uncover the real meaning for markets and, well, beyond.
Okay, let's unpack this first incredibly impactful theme. Artificial intelligence, it's undeniably reshaping our world, but today's headline suggests it's also creating this massive, almost unprecedented divide right within the tech market itself. We're looking specifically at a Bloomberg article titled, "AI Exacerbates Tech Divide with Smaller Stocks Languishing." What's the core finding here?
Well, the striking detail is just the sheer scale of this divergence and, honestly, how quickly it seems to have developed. Data compiled by Bloomberg shows that a measure of smaller tech stocks, small caps, companies with lower market capitalization, they're now trailing a gauge of large cap shares by the widest margin in 30 years.
30 years. Wow.
Yeah. I mean, to put that in perspective, while giants like Microsoft and NVIDIA have just soared, right, 24% and 36% respectively this year, boosting the large cap tech index by a healthy 16%. The small cap tech index is actually down 1%.
Down 1%. That's not just a gap. It feels like a chasm.
It really is.
So what exactly is the fundamental force driving this? Is it purely a matter of capital, or are there other factors, things smaller companies just can't overcome?
It really comes down to resources. And the strategic nature of AI development. Tina Ting, she's head of Global Index Portfolio Management at Franklin Templeton. She points this out very clearly. She notes that small and mid caps simply don't have the ability, or frankly the excess capital, to compete with the large caps in this intense AI race.
Right.
Consider this staggering fact for context. Microsoft alone expected to pump $86 billion into capital expenditures in its 2026 fiscal year.
86 billion.
Billion. That's a sizable percentage of the entire small cap tech index, which is only around $180 billion total.
Wow.
The sheer investment power of these giants is almost incomparable. They can buy the best talent, the best hardware, innovate at a pace smaller firms can only dream of.
Okay, so beyond just that huge capital expenditure gap, are some of these smaller tech companies facing something more fundamental, like an existential threat from AI itself? Are they fighting for survival?
They absolutely are.
Yeah.
Companies like Wix.com, the website building tools, and Chegg Inc., the online education platform. They operate in businesses that could genuinely be made partially or wholly obsolete by new AI technologies. AI offering similar services more cheaply, maybe more effectively.
Disrupting their core model.
Exactly. And this direct threat has seen their shares tumble 44% and 22% this year, respectively. It's a stark warning. And even among the smaller AI companies that did grab attention, some, like Figma Inc., they chose to stay private until they were already basically large cap valuations.
So inaccessible to public small cap investors.
Right, the folks who might have wanted to get in early. And others, like C3.ai Inc. and BigBear.ai Holdings Inc., they've seen their shares just crater after recent results that were deemed unacceptable. It signals that even the dedicated AI plays are struggling if they can't deliver on the, frankly, immense hype.
Given what you've just said about resources and these existential threats, I imagine the earnings reports must paint an even clearer picture of this divergence.
Oh, absolutely they do. While roughly 77% of small-cap tech companies, they did manage to beat earnings and revenue expectations this season.
Which sounds okay on its own.
It does. But compare it. Over 91% of large-cap tech companies topped on earnings. Stephen DeSankis, he's a small and mid-cap equity strategist at Jefferies. He points out quite simply that the market pays for growth, and the growth you see at large-cap tech is just that much better.
So the money follows the big growth numbers.
Precisely. He anticipates small-cap tech earnings growth will accelerate eventually, but he's pretty clear it's unlikely to close that massive performance gap entirely. The market is truly favoring where the concentrated proven growth is, and right now, that's undeniably with the mega caps. I mean, the core insight here seems to be that AI isn't some rising tide lifting all boats. It's more like a financial force multiplier. Companies with deep pockets aren't just gaining an edge, they're fundamentally altering the landscape. Capital allocation, not just innovation, is kind of the new battleground for tech leadership.
And this sheer dominance, of course, raises a critical question for the broader market. It's one that Barron's recently tackled in an article titled, As Tech Stocks Rally, Risk Rises, Why Energy and Healthcare Could Be Options. It observes that the S&P 500 is increasingly becoming, well, basically the S&P Technology Index. What does this mean for overall market health and, diversification?
If we connect this to the bigger picture,
Yeah.
yeah, the concentration is truly remarkable.
Yeah.
And maybe a little concerning. Tech now accounts for a record 34.5% of the S&P 500's total market cap of $54 trillion.
34.5%.
Yeah, that's a significant jump from just 20% back in 2018. And get this, if you reclassify companies like Meta, Alphabet, Amazon, Tesla based on their actual tech exposure, not their official sector, the true tech weighting is closer to a stunning 45%.
45%.
Yeah, and this matters immensely because over $10 trillion is directly linked to the S&P 500 index through ETFs, mutual funds, all sorts of investments. So what moves the S&P 500 largely moves a huge chunk of global capital.
And the individual size of these tech leaders is truly astounding, creating a very top-heavy index. You mentioned NVIDIA's market cap is now basically the entire healthcare sector. Is this healthy? What risks does it pose?
Indeed. NVIDIA, for example, is now the S&P 500's top stock at 8% of its value, a $4.5 trillion market cap.
It's just staggering.
It is, nearly equal to the entire healthcare sector. This concentration, combined with what are seen as very high valuations, tech stocks trading at an average of 30 times forward earnings, 10 times sales.
Right.
That raises significant risks.
Can you quickly remind listeners what forward earnings means?
Sure. Forward earnings refers to the expected earnings per share over the next 12 months. So a price to earnings or PE ratio of 30 means investors are paying $30 for every $1 of expected future profit.
Reflecting high expectations.
Very high expectations, a premium valuation. And 10 times sales means the company's total value is 10 times its annual revenue. What's more, the surging capital spending on AI by these giants, like Alphabet, projecting $85 billion in CapEx this year. That's challenging the old argument that tech companies needed only modest capital spending.
Right, the asset-light model.
Exactly. As Cole Smead, co-manager of the Smead Value Fund, shrewdly put it, tech industry CapEx is looking similar to the oil industry.
That's a huge shift.
It really is, suggesting these tech leaders are becoming heavy industrial players in their own right, needing massive upfront investment to build out the AI infrastructure.
Okay, so if tech's looking concentrated and maybe, potentially overvalued, where does that Barron's article suggest finding diversification? Let's start with energy. It certainly had its ups and downs lately. What makes it an attractive option right now?
Well, that naturally leads to the question, where can investors find value outside this highly concentrated tech sector? The Barron's article specifically points to laggard healthcare and energy stocks as potentially good additions for diversification. They're often overlooked when tech is soaring, but they offer distinct advantages. Energy stocks, measured by the Energy Select Sector SPDR ETF, they're about flat so far this year. Many exploration and production companies are actually down 10%.
Okay.
Despite that underperformance, they look cheaply valued, closer to 15 times earnings, which contrasts sharply with tech's 30 times.
Half the valuation, basically.
Pretty much. And Cole Smead, who we just mentioned, he views this as one of the best buying opportunities in energy in maybe a decade. He notes, interestingly, that conventional energy is crucially needed to power AI. That's a factor the stocks don't yet seem to reflect.
That's a great point.
Yeah. U.S. crude oil prices are down about 10% this year to $63 a barrel, but many think this might be near a bottom. Safer plays like ExxonMobil, Chevron, they trade for about 15 times forward earnings and yield about 4%. So compelling options if you're looking for value and income.
And what about healthcare? It seems like it's faced some headwinds lately, drug pricing, policy shifts. Is it truly turning a corner, or are those headwinds still a big factor?
Healthcare stocks did start to show some life last week, rising 2%, but the sector is still down 3% this year overall. And yes, there are valid concerns. Drug pricing is always a political football. Tariffs could impact them, potential shifts in health policy under the current administration. However, Goldman Sachs research indicates healthcare is as cheap as it has been relative to the broader market in 30 years.
30 years again. That suggests significant untapped value if those headwinds ease up.
That's the thinking. If those clouds lift, there could be a lot of potential there.
Are there any specific companies or trends standing out in healthcare? Maybe even a vote of confidence from a certain famous investor, perhaps?
Yes, actually. Two industry leaders, Eli Lilly and United Health Group, have seen their stocks depressed but might have bottomed out. Lilly, a dominant player in diet drugs with Zepbound and Mounjaro.
Big names right now.
Huge. They recently saw their stock fall 10% on some data about their new diet pill, or orforglipron. However, analysts like UBS's Trung Hun and JP Morgan's Chris Schott, they remain bullish. They cite Lilly's strong drug pipeline and attractive valuation for projected high teens annual earnings growth,
Okay.
and United Health. It's been the worst performing stock in the Dow this year, down nearly 50% at one point.
Ouch.
Yeah, but it surged about 8% after hours yesterday, following some very interesting news.
Which brings us neatly to the latest from none other than Warren Buffett's Berkshire Hathaway, detailed in another Barron's piece. Berkshire buys United Health shares, lifts veil on 3 mystery stocks. What did the Oracle of Omaha, or, well, maybe his team do?
This is quite the reveal, and it confirms that even the biggest names, the smartest money in investing, are seeing opportunities beyond the tech giants. Berkshire Hathaway bought just over 5 million shares of United Health, worth about $1.6 billion during the second quarter.
Okay, so that likely helped the rebound.
Undoubtedly contributed to United Health's stock rebound, yeah. And they also finally revealed their mystery stocks from Q1.
The ones they kept confidential for a bit.
Exactly. They turned out to be home builders, Lennar and D.R. Horton, and the steelmaker Nucor.
Interesting mix, home builders and steel.
It is. And what's also interesting is that these were relatively small investments for Berkshire's huge, nearly $300 billion equity portfolio. It suggests they might be purchases by the managers, Todd Combs or Ted Weschler, rather than Buffett himself.
Who usually goes for those really big needle-moving investments.
Right. But regardless of who pulled the trigger, it reinforces the idea that smart money is actively looking for overlooked value and strategic diversification.
Absolutely. It's a clear signal. Even when the market seems dominated by a few behemoths, there are compelling reasons to look elsewhere. Let's pivot now to the broader global economic picture. Starting with some fairly sobering news from China. Covered in Bloomberg's China economy abruptly weakens, an ominous sign for outlook. And also, price war hits to China. Corporate profits confirm investor fears. What's this synchronized slowdown telling us?
Well, the striking detail is just the breadth of the slowdown across China's economy in July. It's not isolated to one sector. Production at factories and mines rose at the slowest rate since November, only 5.7%. Retail sales grew a meager 3.7%, the least this year. Fixed asset investment decelerated significantly.
Across the board weakness, then?
Pretty much. Even the urban unemployment rate climbed to 5.2%. It paints a comprehensive picture of broad-based weakness setting in.
And this isn't just about slowing growth momentum, right? There are specific policy choices and external pressures really compounding the problem for China.
Precisely. Homan Lee, a senior macro strategist at Lombard Odier, stated pretty bluntly that July's main economic indicators suggest that the country's tariff-related swoon has begun.
So linking it directly to Trump's tariffs.
Directly indicating the undeniable impact. And domestically, Beijing's crackdown on what they call destructive price wars, a phenomenon they refer to as involution.
Involution. Can you explain that term?
Yeah, it's interesting. Involution in this context basically means a kind of internal cutthroat competition where companies just ruthlessly undercut each other. They squeeze profit margins down to almost nothing in a race to the bottom, often just to survive rather than to innovate or grow.
Okay, so it stifles real progress.
Exactly. And that crackdown, trying to stop this destructive cycle, is also casting a significant pall over corporate profitability. We've seen this directly with GD.com's quarterly profit getting halved. Geely Automobile's stock tumbled after reporting a drop in net income, blaming intense competition in the EV sector.
Wow. It sounds like a truly challenging environment for Chinese companies right now. Pressure from all sides. What's the outlook for Beijing's response? More stimulus.
It definitely is a tough spot. The scale of these profit shortfalls certainly heightens the risk for rivals like Alibaba and Meituan, who operate in similar, intensely competitive spaces. And, adding to the concern, new yuan-denominated loans actually contracted for the first time in 20 years.
Contracted, not just slowed, but
Shrank, which starkly highlights a subdued willingness for both borrowing and spending within the economy. People and businesses are pulling back. Bloomberg Economics reinforced the case for more stimulus from Beijing, though the government might opt for smaller, more targeted measures if needed, rather than a massive, bazooka-style injection.
Okay, from economic policy to high-stakes geopolitics. We have a significant development today concerning oil markets. Bloomberg and Barron's are both covering the Trump-Putin meet as prices drift lower and how it could send oil prices wild. What's truly at stake in this high-profile meeting, particularly for oil prices?
Well, the key question is market stability, or maybe instability. Oil prices are drifting lower as investors nervously await this face-to-face summit between Donald Trump and Vladimir Putin in Alaska today. Russia is, remember, the largest crude exporter after Saudi Arabia, and they've become heavily reliant on buyers in China and India who purchase oil at a discount.
A critical lifeline for their economy given the sanctions.
Absolutely. It's a critical part of their economy right now.
And President Trump has been explicitly using tariffs and other pressures as leverage here, specifically targeting those Russian oil purchases by countries like India.
He has been quite assertive, yes. Trump announced a doubling of tariffs on Indian goods to a punitive 50% last week, explicitly as a penalty for their purchases of Russian crude.
Wow, 50%.
And he has also mulled further crackdowns on the so-called shadow fleet of tankers that transport Moscow's supplies.
The shadow fleet.
Yeah, these are basically vessels operating discreetly, often without standard insurance or oversight, trying to avoid sanctions. They're a key part of Russia's ability to keep selling oil. Now, any signs of progress towards a deal to end the conflict in Ukraine, that would immediately remove a layer of geopolitical risk from the oil market. It could potentially weigh heavily on prices, maybe even driving crude benchmarks below $60 a barrel.
But the flip side.
The flip side, if the talks collapse or if the U.S. imposes even stricter sanctions on that shadow fleet or buyers, prices could easily top $80 a barrel.
So huge potential swing depending on the outcome.
Exactly. Analysts like Arnold Lohmann Rasmussen are pretty skeptical of significant results from this meeting. And in any case, any real market reaction won't come until Monday, as the talks conclude after oil trading closes today.
It really highlights how political outcomes can have immediate, dramatic market impacts.
For sure. Geopolitics is firmly in the driver's seat for oil right now.
Okay, shifting to another country grappling with tariffs. Switzerland is in the spotlight today with a Bloomberg article, Swiss economy unexpectedly expanded before 39% tariff hit. This seems counterintuitive, Ray. Growth despite the tariff pressures.
It is an interesting counter-narrative to the general gloom surrounding tariffs, yeah. Switzerland's economy unexpectedly grew by 0.1% in the second quarter. That was actually better than the forecast, which was for a slight contraction of 0.1%.
So some resilience there.
Some resilience. But this momentum came before the country was hit with that painful 39% U.S. tariff rate, which is the steepest among developed nations.
39%.
Ouch. Yeah. So while analysts are cautiously optimistic a recession can be avoided, the strong Swiss franc also isn't helping their exporters. Makes their goods more expensive abroad, potentially eroding that growth going forward.
So they're actively pushing back against these tariffs, trying to negotiate a better deal. It sounds like they're taking it very seriously, even to the point of companies considering leaving.
They absolutely are. The Swiss government is actively negotiating, trying to secure a lower tariff level. They're hoping for revision by the end of October, and companies like the renowned chocolatier Lindt and Sprengli. They're even considering moving production outside Switzerland to avoid these tariffs.
Wow, Lindt leaving Switzerland, that says something.
It highlights the very real impact on their cost structure. And major pharmaceutical giants like Roche and Novartis, huge players in the Swiss economy, they're in discussions with the government too. That's because Trump has stated plans to announce measures on their sector, which could lead to a significant slowdown in GDP growth if tariffs are applied there. It's a really high-stakes game for their economy. Establish global supply chains being directly threatened by trade policy.
Okay, let's bring it back home to the U.S. Wall Street's hopes for rate cuts seem to be riding very heavily on the resilience of the American consumer. Discussed in Barron's, retail sales need to show a resilient consumer. Wall Street is depending on it. And also Bloomberg's stocks hold near highs with consumers in focus. How much strain can the U.S. consumer realistically withstand at this point?
That's the million-dollar question, isn't it? Sustainability. Federal Reserve Chair Jerome Powell himself stated that consumer spending is a data point the central bank pays the most careful attention to. Economists expect July retail sales, the data is coming out soon, to gain 0.5%. That'll be a slight deceleration from June, but still pointing to pretty solid trends, partly boosted by summer holidays, Amazon Prime Day, things like that.
So the market wants a Goldilocks number. Not too hot, not too cold.
Exactly. The market is really hoping for a report that's right down the middle. Not too hot to spark inflation fears and maybe push the Fed away from cuts, but not too cold to signal real economic weakness.
It's a delicate balance.
It really is. Any significant surprise either way could quickly shift market expectations for interest rates.
But are there underlying cracks in that consumer resilience? We hear about the strong headline numbers, but it's not a uniform picture across all income brackets, is it?
No, absolutely not. A Federal Reserve Bank of Boston report indicates that the overall inflation-adjusted spending we've seen since 2022 has largely been propelled by wealthier Americans. People who maybe had the means to pay off debt during the pandemic built up savings.
Okay.
Spending among lower-income households, however, has been much weaker. And their credit card debt levels, they're actually higher than they were back in 2019 before the pandemic.
That points to some real
It
strain.
points to long-standing cracks beneath the surface, yeah. Meanwhile, we're seeing wholesale prices, the Producer Price Index, mark their fastest monthly increase since May 2022, rose 0.9% from June,
And that's partly tariffs again.
partly due to early tariff impacts, yeah, which could eventually feed into consumer prices down the line. So it really suggests that the current consumer strength might be disproportionately driven by a segment of the population, leaving a more vulnerable underlying economic base.
And how does this all tie into the Fed's next moves? Especially with so much riding on this consumer data. Money markets are pricing in a cut, but is the market potentially underestimating certain risks?
Well, money markets are currently pricing in around a 93% chance of a quarter-point rate cut when the Federal Reserve meets next month.
Pretty high probability priced in.
Very high, reflecting that dependence on consumer spending holding up and inflation continuing to cool. However, John Stopford from 91 Asset Management, he was discussed in Bloomberg's 91 Stopford Says U.S. at Epicenter of Market Risk, argues that markets might be a bit complacent, failing to adequately prepare for a potential sell-off driven by Trump's policies and their, frankly, unpredictable nature.
Seeing the U.S. as the main source of uncertainty right now.
Exactly. He sees the U.S. as the epicenter of uncertainty, stating there's an awful lot of optimism priced in and not a lot of risk premium. It suggests a potential disconnect between the market's relatively calm sentiment and the underlying political and economic risks that could, materialize pretty quickly.
And finally, what about the impact of these potential cuts on longer-term rates? Will they actually bring down the cost of borrowing for homes, for businesses,
Yeah.
maybe even help with the national debt?
That's a crucial point because historically, not all rate cuts are created equal in their impact on long-term rates. Data trick research, featured in that Barron's piece, What's Ahead for the 10-year Treasury Rate After the Fed Cuts, suggests something interesting. While 10-year Treasury yields tend to decline when the Fed cuts rates, the picture is significantly different if the economy isn't actually in a recession when those cuts happen.
Okay, so cuts outside of a recession are different.
Yeah. In non-recession periods, there's nearly a 50-50 chance of the 10-year yield rising or declining after a cut. The average move is essentially zero, flat.
Huh. That's not great news for Washington then.
Not really. Washington desperately wants lower long-term rates to reduce the cost of servicing the huge national debt, where about 70% is longer-dated bonds. So a Fed cut, even if it happens, might not provide the broad relief some are hoping for on that front, particularly for the government's borrowing costs.
Wow.
Mm.
What a packed Friday morning. We've really covered a lot of ground. We've unpacked the widening tech divide driven by AI, explored diversification opportunities in energy and healthcare, tracked significant economic shifts in China and Switzerland battling tariffs, and dissected that intricate dance between the U.S. consumer, inflation, and the Federal Reserve's next moves.
The overarching theme today really feels like adaptation and resilience, doesn't it? In the face of just unprecedented change. From companies needing to find totally new business models because of AI disruption, to investors needing to seriously think about diversifying beyond concentrated tech, to central banks and governments grappling with tariffs, shifting economic indicators. It's just a dynamic and incredibly complex landscape. The rules seem to be constantly evolving. It's
So critical thinking is key.
absolutely paramount. Understanding the interconnectedness of all these global forces, I think the real takeaway isn't just, diversify. It's maybe recognizing that even stable sectors like healthcare or energy now play a critical role in powering the new economy. They're bridging the old and new investment paradigms in some surprising ways.
That's a great way to put it. So, for you, the listener, think about how these major economic and geopolitical shifts might reshape your own understanding of risk and opportunity in the coming months. What stands out to you about the impact of these policies on different sectors or countries? Something to mull over this weekend. We'll see you all tomorrow morning with new headlines from major financial magazines.